So my name is Mark Chandler. I'm the chief currency strategist, chief market strategist at Bannockburn, which is a sister company under the umbrella of the First Financial Bank. And I basically spend my day talking with clients, helping them manage three types of risks: currency risk, interest rate risk, and commodity risk. This business cycle has been very unusual for understandable reasons. The pandemic, the reopenings, the war in Europe, the war in the Middle East, the tensions in the Pacific, uh, and it's been difficult. And many people have been talking about a recession basically since the pandemic itself. And I think that what we've seen in recent weeks is that the U.S. economy does seem to be slowing in a desired way for the Federal Reserve, which has been fighting inflation. We're seeing what's important, I think, for our clients is that the U.S. economy does appear to be slowing. Labor force growth, that is, job growth, is slowing, and price pressures are moderating. And this will ultimately lead to the Federal Reserve finally being able to cut interest rates, perhaps late here in Q3. Many of us have been hoping for lower interest rates, and this is good for businesses. Generally, lower interest rates, cost of capital can fall. The internal threshold to make investment decisions can be lower, allowing a broader range of projects, including mergers and acquisitions. It's kind of interesting because, as the markets begin pricing in this Fed cut in September, the stock market has reached, and by the stock market, I mean like some of the major indices like the S&P 500 and the tech-heavy NASDAQ has made record highs. And so the markets are stretched. And in the U.S., as you're familiar with, the market has really been at a very narrow, that is to say, the stocks that are participating in this rally, in the strength of the rally, seem to be of a limited number, less than a dozen. And so the other rule of thumb I think that's important to keep in mind is, even though, as I said, we like lower interest rates, typically the stock market sells off in the 12 months after the first rate cut. Typically, I'd say the Federal Reserve doesn't do anything one at a time, which means that we should be expecting a series of cuts well into next year. And this is what the Federal Reserve itself signaled at the June meeting, when they signaled, and the way they signaled this is called the Summary of Economic Projections, which you could find on the internet, it's publicly available. And what it does is, among the Fed officials, they cast their numbers. They put in their numbers, and the Federal Reserve publishes those numbers at a median. And the median was looking for one cut this year, three cuts next year. And I think it still is prudent to expect more rate cuts next year, that the easing cycle will just begin, I think, in September, but will go well into next year. There'll be a lot of uncertainty still, and we're going to be trying to, people, I think, a lot of economists have been debating for months now about recession. What does it look like? What sectors? And I think that that's what we should be expecting is this gradual economic slowdown. The past Fed rate hikes and past hikes, interest rate increases likely continue to dampen activity as we head into the new year. And like I said, I think that slowdown is likely to broaden into next year. And I think that affects, like I mentioned, pricing power, demand, and especially in the consumer goods sector. And so I think that the first quarter of next year, we're going to be debating about, are we in this proverbial recession or not? And the valuations seem very rich now. And I think that over time, the idea is to buy assets below fair value. And because they're rich now, I think the two things I think that are needed is lower asset values, and also confidence in the regulatory and tax environment. And the regulatory and tax environment might not be clarified until we see what happens in the November election. But on a valuation basis, I think that the sort of rule of thumb, I think, is really buying assets below fair value, which over time, you don't need to have this bigger sucker theory. You buy a very expensive asset, and you look for someone who's more foolish than you to buy it from you. Instead, the idea is to buy an asset below fair value. So all it has to do is go to fair value for you to make money. You don't have to depend on anybody else's foolishness.